Well, people always want to know what I'm buying, which stocks look attractive, where the opportunities are. And those are good questions. But over 5 decades of investing, I've learned something simple. Knowing what to avoid is just as important as knowing what to buy, maybe even more important. You can make a lot of money by buying the right things, but you can lose everything by buying the wrong things. One bad decision can wipe out years of good decisions. So today, I want to talk about something I don't discuss as often, the sectors I'm avoiding in 2026, and more importantly, why I'm avoiding them. This is not about being negative. It's about being realistic. It's about understanding risk. It's about recognizing when the odds are not in your favor. It's about protecting capital. And that's the first rule of investing. Back in October 2025, I was on CNBC talking about how we're in an AI bubble. I said, it's not like tulip mania where everything vanishes. It's more like the dot-com bubble where tons of investments become dead ends. That kind of thinking shapes how I approach what to avoid. I've seen bubbles burst before. I watched what happened in the late 90 seconds when everyone chased internet stocks. Hype blinds people to fundamentals, and that's why even as I invest heavily in AI through Microsoft and the foundation, I'm cautious about overvalued sectors tied to that hype. Before I get into the specific sectors, let me tell you a story that shaped how I think about avoiding bad investments. It was back in the late 1970 seconds and early 80 seconds. I was running Microsoft, and the core software business was struggling. The industry was still young. Competition from bigger players was intensifying. Development costs were high. Technology moved fast. We tried everything. New equipment, better management. Cost cutting, nothing made much difference. I eventually pivoted operations in the mid 80 seconds, but I should have done it years earlier. I held on too long because I didn't want to admit failure. I felt loyalty to employees and the community. I kept thinking we could turn it around. But the fundamental problem was that I was fighting against powerful, irreversible forces. The early software industry was chaotic, and no amount of effort could change that without the right breakthroughs. We were dealing with hardware limitations, skeptical customers, and a market that was not fully ready. It felt like pushing against a tidal wave. I remember nights staring at code and projections, wondering if we'd make it. That experience taught me a crucial lesson. When you're fighting against powerful secular trends, you're probably going to lose. It doesn't matter how smart you are. It doesn't matter how hard you work. Some industries face headwinds so strong that even great management can't overcome them. The key is recognizing those situations early and avoiding them entirely, or getting out quickly if you're already in. So let's talk about the 5 sectors I'm avoiding in 2026. These are not necessarily bad sectors forever. Some might bounce back eventually. But right now, the risk to reward does not make sense to me. The odds are not favorable. And in investing, you don't need to swing at every pitch. You can wait for the fat pitches, the ones right in your sweet spot. I've always believed in patient capital, and I've tried to focus on sectors with tailwinds, not headwinds, whether that's long-term work through the Gates Foundation or long-term innovation through areas like clean energy. First, I'm avoiding commercial real estate, especially office buildings. Real estate has created wealth for a lot of people for a long time. And I'm not saying all real estate is bad, but office real estate faces serious structural challenges that I believe will persist for years. The pandemic in 2020 permanently changed how many people work. Before the pandemic, most office workers went in 5 days a week. Then suddenly a lot of work moved home. Companies discovered many jobs could be done remotely with little loss in productivity. Employees discovered they liked flexibility and not commuting. A few years later, we're seeing the lasting impact. Hybrid models are common. Some companies are fully remote. Even companies that want everyone back struggle to enforce it because employees have leverage in many labor markets. The result is simple. Office utilization is down from before the pandemic. Too much supply, not enough demand. Companies are downsizing footprints. When leases renew, tenants take less space or demand lower rents. Vacancy rates in many cities are high and in some cases near record levels. The financial implications are severe because office buildings are typically financed with a lot of debt. Rental income was supposed to cover debt service and produce returns. But with vacancies high and rents falling, many buildings cannot generate sufficient income to cover payments. Owners default, values fall. We've already seen office buildings sell for dramatically less than a few years ago. Some people think that creates an opportunity that you can buy distressed offices cheap and profit when things normalize. But I don't think we are going back to the old normal where everyone returns 5 days a week. Remote and hybrid work appear durable for many industries. And there are serious questions about what happens to these properties. Converting offices to apartments sounds good, but it's often not economically feasible. Offices are designed differently. Plumbing, electrical, HVAC, floor plates, windows, all of it. Conversion costs can be enormous and sometimes exceed what the finished apartments are worth. Some buildings will convert. Many will sit vacant, limp along, or be demolished. I'm also worried about knock-on effects in the financial system. Banks hold a lot of commercial real estate debt. Losses rise as borrowers default and collateral values decline. We've already seen stress tied partly to commercial real estate exposure, and I think there can be more. That's why I avoid the sector, not because there is no future at all for real estate, but because office buildings have structural headwinds and leverage that can turn slow declines into crises. Second, I'm avoiding traditional retail, especially department stores and shopping malls. This has been challenged for years, and I do not see it getting easier. The shift to e-commerce keeps strengthening. Think about how you shop compared to 10 or 15 years ago. More online, less physical visits. Even in stores, many people comparison shop on their phones. That shift has been devastating for businesses built around physical stores. Department stores were once anchors of malls. They drew traffic, but the model is broken. Huge inventories across categories. Expensive prime real estate, high labor costs, weak ability to compete on price against online retailers, and weak ability to compete on convenience against delivery. We've seen waves of bankruptcies. Stores that dominated American shopping for generations have disappeared or shrunk dramatically. Malls suffer too. When anchors close, foot traffic declines. Other retailers leave. The mall enters a death spiral. Hundreds have closed and more may follow. Survivors often shift toward mixed-use redevelopment with apartments, offices, or entertainment, anything besides traditional mall retail. Now, not all retail is dead. Grocery remains resilient because people still buy food and like selecting fresh items. Home improvement can hold up because people want to see materials and get advice. Some discount formats have held up. But department stores and many malls are fighting structural change. Even if the economy is strong, more spending flows through online channels. Why invest in a sector facing powerful adverse trends? Third, I'm avoiding traditional media and entertainment focused on broadcast television, cable networks, and linear distribution. The media industry is going through massive disruption, and old models are breaking down. For decades, television worked in a stable way. People subscribed to cable or satellite, paid monthly fees, watched a bundle of channels. Advertisers paid for commercials, networks bought shows. It was profitable. Now that system is collapsing. Streaming changed the game. People, especially younger audiences, do not want bundles full of channels they never watch. They want to watch what they want, when they want, often with fewer ads. Cord cutting continues. Cable providers lose subscribers, advertising fragments across platforms. And while many legacy companies launch streaming services, most are fighting brutal competition and often losing money on streaming because content is expensive and consumers are not willing to pay enough to cover everyone's costs. So you get value destruction. Companies that once controlled distribution and monetized bundles are now competing in a world where customers have more power and switching is easy. Fixed costs remain. Revenue per customer often declines. And there is a deeper risk. Live sports has been a major reason people kept cable, but leagues are increasingly selling streaming rights directly or to tech firms. As sports moves, cable loses its last strong advantage, cord cutting accelerates, and the old economics get worse. There will be winners in the new world, especially platforms with scale and strong technology, but the traditional media companies are fighting a hard battle. Even if they stabilize, they may emerge smaller and less profitable than in the cable era. That's not where I want to allocate capital. Fourth, I'm avoiding Chinese technology companies. This is complicated, and I want to be careful because there are impressive Chinese companies with strong businesses and talented management teams. In a different environment, some might be attractive, but the risks right now are too high for me. The core issue is political and regulatory risk. The Chinese government has shown it will intervene dramatically in private businesses when it believes party control or social stability is at stake. We've seen sudden crackdowns across sectors, and enormous market value can disappear quickly after regulatory actions. As an investor, I need to predict with reasonable confidence what a business looks like in 5 or 10 years. I need to understand the rules of the game. In China, the rules can change suddenly. There are also concerns about corporate governance and minority shareholder rights. Some ownership structures are opaque. Management incentives may differ from outside shareholders. If something goes wrong, legal recourse can be limited compared to what investors expect in the United States or other developed markets. Geopolitical tensions add another layer. There is ongoing discussion about restrictions, delisting risks, sanctions, counter-sanctions, and chip and AI tensions. Regardless of how it plays out, it adds uncertainty. I would rather avoid. I'm also concerned about the reliability of financial information in some cases. We have seen fraud and misrepresentation in the past. Auditing standards and enforcement can differ. If I can't trust the numbers, I can't value the business properly. This does not mean China is uninvestable forever. The economy is huge. Innovation exists. Opportunities exist. But for me in 2026, the risks outweigh the potential rewards. Fifth, I'm avoiding speculative technology, specifically companies with no profits, no clear path to profits, and valuations based mostly on hope and hype. Let me be clear, I'm not against technology. Some of my best investments have been in established technology businesses with proven models, strong cash flows, and durable competitive advantages. That's very different from speculative technology. When I say speculative technology, I mean businesses burning cash, generating minimal revenue, years away from profits if they ever get there, yet valued at billions because of a story about future potential. Maybe it's autonomous vehicles, quantum computing, new AI systems, space, crypto-related applications, whatever the current narrative is. The problem is You are not buying a business in the traditional sense. You are buying a story. You do not know what the economics will be even if the technology works. You do not know what competition will emerge. You do not know what the market will pay. You are speculating. Yes, some will succeed spectacularly. Early investments in certain winners can be life-changing. But for every huge winner, there were dozens or hundreds of failures, especially in the dot-com era. Most investors only remember the survivors. They forget the graveyard. I've never thought my edge was in identifying which speculative bets will pay off. I do not want to try to value companies with no profits and uncertain prospects. My strength has always been evaluating established businesses, understanding competitive positions, valuing cash flows, and buying at reasonable prices. If I cannot do that analysis, I move on. There are plenty of opportunities where I can apply what I understand. I'm also worried about valuation math in a world where rates normalized. When discount rates are higher, the present value of distant future profits is lower. That hurts businesses priced entirely on future dreams. Some speculative companies will run out of funding and fail. I would rather miss an occasional big winner than take serious capital losses on many losers. You'll notice a few common patterns across these 5 avoided sectors. 1, several face powerful secular headwinds. Office real estate is dealing with lasting changes in work patterns. Traditional retail is fighting the shift to online shopping. Traditional media is dealing with the collapse of the cable bundle. These are structural changes, not quick cyclical issues that disappear when the economy improves. When you fight structural change, you usually lose. 2, several involve risks I can't quantify well. Chinese regulatory and political risk is hard to model. Speculative tech's path to profitability is extremely uncertain. When I can't quantify risk, I avoid it. 3, several are trying to adapt but face enormous disadvantages. Retailers try to build online businesses while competing with born digital giants. Media companies try to shift to streaming while managing the decline of legacy revenue. It is hard to rebuild an airplane mid-flight. This ties into a principle. Declining businesses rarely turn around. Once structural decline sets in, management often talks about transformation, but many times they are managing decline. Another principle is staying honest about what you understand and what you do not. Staying within your circle of competence has been one of the most important ideas in investing. Missing out is not fatal, blowing up is. And there's something else. Pride and stubbornness cause investors to hold on too long. They do not want to admit they were wrong. They keep hoping. They throw good money after bad. The key is being ruthlessly objective. Just because you own something does not mean you should keep owning it. Ask yourself, if I did not own this today, would I buy it at this price and with what I know now? If the answer is no, you should seriously consider selling, even if it means taking a loss. A small loss today can prevent a catastrophic loss tomorrow. I'm not saying there are never exceptions in these sectors. There might be special situations. There might be rare companies that are genuinely different. But those are exceptions, and you need very strong conviction to believe a single company will succeed while a whole sector struggles. For most investors, the safer approach is to avoid troubled sectors and focus on businesses with favorable tailwinds, strong competitive positions, and good long-term economics. I think about investing like baseball with one huge difference. In investing, there are no called strikes. You don't have to swing. You can wait if a sector looks troubled, if a business seems risky. If you don't understand it, you can pass. There is no penalty. Most investors forget that. They feel they must always be invested. They feel they must chase what is hot. That leads to mistakes. As I think about 2026 and beyond, I'm comfortable avoiding these 5 sectors: commercial office, real estate, department stores, and malls. traditional linear media, Chinese technology, speculative technology with no profits and no clear path, the risks are high, the odds are unfavorable, and there are better opportunities elsewhere. And let me emphasize why avoiding mistakes matter so much. The math is brutal. If you lose 50%, you need a 100% gain just to get back. Big losses destroy compounding. If you avoid major mistakes, you can do very well over time with steady, reasonable returns. Protect capital first. That gives you the freedom to invest when real opportunities appear. Some people might say this is too conservative. Maybe some of these areas bounce back. Maybe you can make money in distressed situations. But here's the truth. I don't need them to succeed. There are plenty of other places to invest where the odds are better and the risks are more understandable. You only have to get rich once. Taking unnecessary risk to get rich faster is how people blow themselves up. So take an honest look at your portfolio. Ask where you were exposed to structural decline, unquantifiable risk, leverage, or hype. Avoid the traps. Focus on durable businesses. Protect your capital. And if this helped you, like, subscribe, and comment your biggest sector to avoid in 2026.